Hi everybody, I'm Elena and I'm the last guest lecturer in our class. Hope you enjoy my presentation. I will talk about revenue-related financial statement fraud. I will be focusing on identifying financial statement fraud exposures, revenue-related fraud symptoms, concentrating more on actively searching for analytical symptoms. Revenue-related frauds, called management frauds, is about recording fictitious revenue. It involves revenue and/or accounts receivable accounts. There are two reasons for revenue-related fraud. One of them is the existing alternatives for recognizing revenue. Because there are numerous businesses, for example, construction, pharmaceutical businesses, oil refineries, they all have different revenue recognition systems. This is why it's hard to develop rules for revenue recognition. And the second one is ease of manipulating net income using revenue and receivables. As Barry Minko stated, receivables are a wonderful thing. You can create a receivable and you have revenue. This means that income can be inflated, manipulated in different ways. By premature revenue recognition, improper cutoff, misstating the work completed, creating fictitious sales, and so on. Every business should be considered for revenue-related fraud exposure. Exposure means schemes that can be used to misstate revenue and receivables. The best way to understand how revenue fraud could arise, it's important to contemplate transactions between a company and its customers. Also, it's important to relate accounts that are involved with potential manipulations, meaning fraud schemes. The most common revenue-related schemes are related party transactions, meaning arrangements that create conflict of interest. Also, sham sales, fictitious sales, bill and hold sales. Sales are recognized while requirement for recognition is not in place. Side agreements are made secret to outside normal business channels. Consignment sales. One company sells goods that are owned by another company, improperly recording consignment. Channel stuffing. Suppliers encourage customers to buy extra inventory, meaning inflates sales. Lapping or kiting. It's misplaced cash receipts. Redating. Refreshing transactions, changing dates to more current ones. Liberal return policies. This allows customers to return products and cancel sales in the future. Partial shipments. Improper cutoff. Transactions that are recorded in the wrong time period. Also called premature revenue recognition. They are very often used. Also round tipping. Selling unused assets for a promise to buy back at the same price. So all these fraud schemes overstate revenue and net income. After all schemes have been examined, scheme-specific symptoms or so-called red flags can be explored. They are analytical symptoms that relate to the term too good to be true records. Accounting or documentary symptoms, this meaning missing documents, photocopies instead of originals, ledgers that don't balance. Lifestyle symptoms, they are more detected in management fraud in smaller companies, as large organizations compensate very well their management. So the management usually benefits indirectly through a higher stock price. Control symptoms. When management is overriding the key controls like segregation of duties, new unusual large customers. Behavioral and verbal symptoms. when fraudsters, they feel guilty, stress, and so on. Tips and complaints might be occurring through a whistleblowing system or other ways. Like in the case of Health South, tips and complaints were actually kind of ignored by Ernst & Young, as auditors received red flags from a letter from a concerned shareholder of Health South. As we will focus on actively searching for revenue-related analytical symptoms, here are the most common analytical symptoms. Revenue sales that appear too high, sales discounts that appear too low, sales returns that appear too low, bad debt expense that appear too low. So when looking for analytical symptoms, the questions that needs to be answered is it too high, too low, or unusual relative to what? This is why we need to look for changes in recorded account balances from period to period, meaning recorded amounts from one period can be compared to recorded amounts from another period by using by calculating changes using the horizontal analysis and studying the statement of cash flow. The most efficient method to detect fraud is by using horizontal analysis, as it represents a percentage changes from one period to the other. Next, it's good to look for changes in revenue-related relationships. Ratio is a good way to discover revenue-related analytical fraud symptoms. The most common ones are gross profit ratio, sales return percentage ratio, sales discount percentage ratio, accounts receivable turnover, number of days in receivables, ratio allowance for uncollectible accounts as a percentage of receivables, assets turnover ratio, and so on. So the change and the speed of changes in the ratio could signal fraud. Also, a vertical analysis is used to identify changes in financial statement relationships. You can simultaneously view relationships between all numbers on the balance sheet and on income statement. So all these analytical tools are good to identify potential problems or problem area, but they all need further and deeper investigation. When actively searching for revenue-related analytical symptoms, we need to compare financial statement information between companies. We need to compare the performance of the company with similar companies within the industry. One example is equity finding fraud. Their financial statements showed high profits and a growing insurance company when other insurance companies from the industry were struggling. Also, another example is World.com. They showed strong performance in the telecom industry when they were committing fraud. And also, we need to compare financial statement amounts with the real world asset that they represent. In conclusion, auditors and fraud examiners need to clearly understand the operations and nature of the organization they are auditing, plus know the industry and its competitors. For revenue-related financial statement frauds to be discovered, revenue-related fraud schemes and symptoms must be observed and recognized. All follow-up measures and procedures should be conducted accordingly. For the various number of companies with various revenue reporting methods, rules are hard to be developed in revenue recognition, which makes it opportunistic for some managers to commit financial statement frauds. Thank you for listening and have a great rest of the summer.